Welcome to our deep dive on the Backdoor Roth IRA and the notorious Pro-Rata Rule that turns a smart strategy into a tax headache. In this video, we'll walk through what the Backdoor Roth is, how the IRS aggregates your IRAs, the common trap that high earners fall into, and the exact steps to execute this strategy cleanly. We'll also show you practical diagrams, a worked example, quizzes, and a year-end checklist so you can avoid expensive mistakes. Let's get started. In this agenda, we'll first define the Backdoor Roth strategy. Next, we'll explain the IRS Pro-Rata Rule in plain English. Then we'll highlight the common trap high earners face when they have pre-tax money in any IRA. After that, we'll cover the fix through a reverse rollover into a current employer's 401k. We'll follow with a step-by-step clean execution process and reinforce learning with examples, timelines, and quizzes. This content is educational only. It is not tax, legal, or investment advice. Your situation may differ, so consult a qualified CPA, tax advisor, or financial planner before making decisions. Rules can change and employer plans vary, so confirm details with your plan administrator and advisor. The Backdoor Roth is designed for high earners whose income exceeds Roth IRA contribution limits. The idea is to contribute non-deductible after-tax dollars to a traditional IRA and then convert that amount to a Roth IRA shortly thereafter. The goal is to get funds into a Roth where they can grow tax-free. However, this simplicity breaks if you hold pre-tax money in any traditional IRA, rollover IRA, SEP IRA, or SIMPLE IRA. That's where the Pro-Rata Rule applies and can make your conversion partly taxable. Under the Pro-Rata Rule, the IRS looks across all of your traditional, rollover, SEP, and SIMPLE IRAs as if they are one combined account. You cannot choose to convert just the after-tax dollars. Instead, any amount you convert is divided into taxable and non-taxable portions based on the ratio of your after-tax basis to the total value of all aggregated IRAs on December 31st. Employer plans such as 401k, 403b, and 457b are excluded from this aggregation. The December 31st balance is critical because it determines the proration of your conversion for that tax year. Here's a concise way to compute the effect of the Pro-Rata Rule. First, determine your after-tax basis, typically tracked and reported on IRS Form 8606. Next, determine your total aggregated IRA balance as of December 31st. Divide the basis by the total to get the non-taxable percentage. Then multiply your conversion amount by 1 minus that percentage to get the taxable portion of the conversion. Finally, make sure you properly file IRS Form 8606 to document your basis and the conversion. Start by checking whether your current employer's 401k accepts roll-ins, because not all plans do. If allowed, request a reverse rollover of pre-tax dollars from all your IRAs into that employer plan. This step removes the pre-tax amounts from the IRA aggregation and is key to avoiding the pro-rata trap. After the rollover, confirm your aggregated IRA balance is zero or contains only the new non-deductible contribution before December 31st. Then, contribute non-deductible dollars to a traditional IRA and convert to a Roth IRA soon after. Converting promptly reduces taxable earnings accumulating between contribution and conversion. Finally, invest according to your plan and correctly file IRS Form 8606 to document your basis and the conversion. In this example, a taxpayer has $100,000 in pre-tax IRA funds and $6,000 of after-tax basis. They plan to convert $6,000. The non-taxable percentage is $6,000 divided by $106,000, or about 5.66%. Therefore, only about $340 of the conversion is tax-free, and roughly $5,660 is taxable. This outcome defeats the goal of a tax-free backdoor Roth. On the left is a clean execution. No pre-tax dollars remain in any traditional, SEP, or SIMPLE IRA by December 31st. The conversion follows promptly after the non-deductible contribution, and Form 8606 is filed accurately. This usually results in a minimal taxable amount. On the right is the costly trap. Pre-tax dollars remain in aggregated IRAs at year-end, triggering the Pro-Rata Rule. The conversion becomes mostly taxable. Errors arise when basis is not tracked on Form 8606, and the taxpayer pays unexpected taxes. Timing matters. December 31st is the snapshot date that determines the pro-rata calculation for the year. Because reverse rollovers take processing time, begin early. When moving funds, use trustee-to-trustee transfers when possible to reduce error risk. Indirect 60-day rollovers can be risky. Recharacterization does not undo a Roth conversion, so plan carefully. To reduce step transaction scrutiny, convert soon after contributing, but ensure you follow your plan's rules and maintain documentation. Always keep thorough records and file Form 8606 correctly. Quiz time. Which accounts are aggregated under the IRS Pro-Rata Rule for backdoor Roth purposes? Option A, only the specific traditional IRA you convert. Option B, all traditional, rollover, SEP, and simple IRAs. Option C, employer 401k and 403b plans only. Option D, only accounts opened in the current year. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. The IRS aggregates all traditional, rollover, SEP, and simple IRAs. Employer plans such as 401k and 403b are not part of the aggregation, which is why moving pre-tax IRA dollars into a 401k can help clean the IRA before the December 31st snapshot. Second quiz. What date determines the IRA balance used for pro-rata calculations each year? Option A, the day you make your contribution. Option B, the day you submit your conversion. Option C, December 31st of the tax year. Option D, April 15th of the following year. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C, December 31st of the tax year. This year-end snapshot determines the taxable and non-taxable split for conversions executed in that year. The key takeaways are as follows. The backdoor Roth is a powerful strategy if executed properly. Any pre-tax dollars in traditional, SEP, or simple IRAs at December 31st will trigger the pro-rata rule. A reverse rollover of pre-tax dollars into a current employer 401k can help clean your IRA before year-end. Convert soon after making a non-deductible contribution, and always file IRS Form 8606 accurately to track your basis and conversion. To wrap up, map all your accounts and identify any pre-tax IRA balances. Confirm whether your employer 401k accepts roll-ins, and, if so, initiate a reverse rollover to clean out pre-tax IRA dollars. Then execute a clean backdoor Roth. Contribute a non-deductible amount to a traditional IRA, convert to a Roth IRA shortly after, and invest according to your plan. Carefully track transactions and file Form 8606 correctly. Begin early, so you are fully prepared before the December 31st snapshot. Thanks for watching. If you found this helpful, please like the video, share it with a friend who might be attempting a backdoor Roth, and subscribe for more strategies to optimize your finances. Tell us in the comments what part of the pro-rata rule surprised you most and what topics you want us to break down next.